Hey everybody, Marty Mazur. Good morning, 29th of September 2016. Got a pretty volatile day going on today, so I thought this would be a good time to interact with the charts on your behalf, talk about the technicals. But I'll start first with the news today that seems to be the catalyst for the sell-off. Looks like the Deutsche Bank's headline or the headline regarding Deutsche Bank that some funds that use its prime brokerage service have moved part of their listed derivatives holdings to other firms this week. Consequently, now this is Deutsche Bank, by the way, has been a fairly embattled bank of late. Big drops in their price, questions in terms of their capital and whether they need to be recapitalized, whether the German government needs to step in, which I think they will. Let me just say, how do you step into the Greek banks without stepping into one of your own that is so systemically important? I'm not going to comment here today in terms of whether I think that's a good or bad thing in the long-term scheme of things, but it's something I fully expect to happen, and it'll be something that will probably dramatically calm the waters that are being stirred up, at least this morning. So globally, banks are kind of taking that hit with them, which is interesting because there's other news the last couple of days that actually should have been pretty positive, at least for U.S. banks, and that's really news about the Fed. Here's this paragraph here. The greenback pared its loss this year to 4% as Fed Chair Janet Yellen said Wednesday that the majority of central banks' policy setting group sees an interest rate increase likely needed this year. And then here the Fed speakers continue to try to set the stage for a Fed rate increase, and I think very likely in December. So that ultimately, amid a good economy, and actually today's economic data, which I'll probably update for you on my weekend message, was supportive of a Fed raising rates. And that's going to make the market nervous because it's just, the market has kind of been on that, for lack of a better term, lifeline for a long time. Now it's going to have to live on better earnings and a better economy and so forth. And when you take the patient off of the drug, I think you're going to see some withdrawal. So expect some volatility. Now, in terms of the charts, a week or so ago, I was pointing to this very what was a temporary range that was pretty specific, and that was 250 to 2150 to 2120 on the S&P. Broke above that, and it looked like traders were buying that 2150 as support. Today it dropped below that, as you can see the bottom of that bar there, but now we're right on it. So it's either going to be support today or it could end up being resistance before the day ends, and then it'll be interesting to see if that 2120, or that what I believe is that strong line in the sand ultimately of 2100 becomes support. As I've been looking at some of the shorter term indicators, volume really doesn't support the market right now. What the on-balance volume chart shows us is that the trend has been that the bigger volume days have been the down days. So that does not support a continuation in the near term of the rally. And then my moving average convergence divergence, kind of messed up here, sorry. That has been giving me somewhat of a bearish divergence. It's moving a little bit more negative than the actual price chart has been moving. Not dramatic. Relative strength has been doing that to some degree as well, but that's been telling me not to be too excited about the market in the near term. And as I was suggesting here, maybe there's some more downside volatility to come. We know there always is, but these are momentum indicators that are showing us a loss of momentum at these levels. So clearly traders were kind of sitting, creating this sideways look, looking for some catalyst, and maybe the Deutsche Bank catalyst is something that'll break us a little bit lower. In a world where sentiment is decidedly bearish, as I've been illustrating lately, much like it was before the Brexit, it'll be interesting to see if we don't get a break lower that'll ultimately be picked up for people who are kind of waiting in the wings for an opportunity to get into some areas that they missed out on earlier. When we look at the technicals from a longer term perspective, it's a different setup. Here's the advanced decline line, which is a measure of breadth. I pointed this to you before. This is the best look of that line. It's the number of advancers versus decliners cumulatively day after day. It's pushing again to an all-time high. That's a very bullish, positive look for the broader market. You can see how the S&P has moved up right along with it. You can see how 2015 looked from an advanced decline line and how that ultimately looked in terms of the market as well. So flatness. Wall Street Journal said 2015 was one of the toughest years on record for folks to make money in the market. wasn't a disastrous year by any stretch. It was just a tough year to do well. When we run that chart back 5 years, you can see again that the last really good year on the AD line was 2013, and we had a phenomenal year in terms of returns on the equity side of our portfolios. As it began to flatten out, as the breadth did, so did the market. Again, 2015, and here we are today. So that's a nice setup. Another one, this will be the last chart today. The moving averages, the 50-day versus the 200-day. When the 50-day is up, it's a good look. Typically, good things happen when this green line is above the purple line. Here's the S&P below, and this goes back 20 years. So here it is in 2006. There was some volatility to ignore in here, but when it finally rolled over, that's right when that tech bubble burst and we had a big bear market in stocks. When it turned up, when people least expected it, then it actually set the stage for a very nice prolonged move higher until with the mortgage real estate bubble, it broke down again, and then we had that big bear market. So we've been sitting in this zone here with some volatility to ignore for long-term investors. Then we had a pretty good break here with the 50-day breaking down below the 200-day. That was that first correction we'd had since 2011, the first 10% correction. Here's 2011. Here we had it again. So not something to ignore for short-term investors, but for our long-term investors, it proved to be just that. This is a very good look. That's a very good shape, and that's a very good acceleration of the 500 or the 50-day versus the 200-day. As you can see. So technicians are saying, oh, that's a very nice setup, and this sloping up, both of them sloping in the right direction, looks very good. Does that mean that things can't turn south? You can see how they did that here. This is a nearer term look at what I just showed you. Of course, it doesn't mean that. There are no guarantees here, folks, but this just speaks to probabilities. And the longer term technicals are basically suggesting that this bull market is not ready to die just yet. Thank you. I'll leave it there, and I will talk to you very soon. Look for the weekend update coming your way probably tomorrow. Take care. Bye-bye.